Hi, thanks so much for tuning in to BQ Prime. This is the Mutual Fund Show. And, it's that time of the year when you're probably receiving emails from your employer asking for proof of investment saving, or rather tax saving investments that you were supposed to have made through the year. And that email is what galvanizes quite a few of us to make those investments. And quite a few of you will be wondering where to invest. Now, one of the most popular options under Section 80C, which is the largest basket of deductions available to you, is the equity-linked savings scheme, and that's what we'll focus on in today's conversation. We'll talk about what these are and how you should make a selection. It is a popular product because as much as 1.5 lakh crore of assets under management in the mutual fund industry fall under this particular scheme. My guests today are Prableen Bajpai, the founder of FinFix, and Kaustubh Belapurkar, who is the director fund research at Morningstar. Thank you so much for the both of you for having joined in on this conversation. Prableen, I'll start with you because I think the foremost question everybody is going to have right now, both those who've just entered the workforce and those who've made these investments before, is how does the ELSS stack up against the various other options that are currently available?
Hi, Alex. Great to be here. So I think there are 4 or 5 popular investment options in India when it comes to tax saving. I think the number one being the Public Provident Fund, and followed by the Employee Provident Fund. And these two belong to the fixed income basket that we have, because we know that this is the rate of return that we're going to get, 7.1 and 8.1% currently on both of these. Then, of course, we have a lot of these investment and insurance-linked options, which is really not a great idea, especially when we're looking at long-term investments. So I'll leave that out, but of course, they are available. Then, of course, is the NPS, which gives us different combinations of corporate bonds, of government securities, and equity. But again, there is a limited percentage to which equity investments are available, going up to a maximum of 75%. And then we have, of course, the tax savers, the mutual funds. And Alex, of course, the fixed income, the first 2 products, PP and EPF, are, we know that we have a guaranteed return on them. We have the tax, exemptions even at the time of maturity of the product. But these 2 are not growth assets. These 2 are fixed income products. And what we have in the growth asset basket is partially NPS and mutual funds. And in terms of return matrix, if we look at somebody who's starting off with their careers today or has been investing, looking at tax saving options as a long-term investment option, let's consider a time period of, let's say, 30 years. If you start at around 25 and are investing till 55, till your retirement, a PPF at 7.1 can actually build up a corpus of 1.5 crores. EPF at 8.1, I'm taking at 8, can build up a corpus of 1.83 crores, of course, higher. NPS, I'm taking it at 10% because it's a combination of these different assets. It can create about 2.71. And with NPS, Alex, we also have the additional 50,000 which can be done. So it makes it about 2 lakhs in a financial year. So it can take us to about 3.61 crores. But ELSS, with a basic 12% assumption, can give us a corpus of 4.05 crores. Even after tax, going by the current taxation, it becomes a better option as compared to the others. But of course, the choice of product depends on what is your, mandatory sort of deduction. If you already have EPF through your employer, what is your overall investment bucket during the month, and of course, what's your risk appetite, what are your goals? So I think cumulatively, all of it should be considered while picking the product.
No, and that's a very nice summation of the options available. Clearly, a lot of salaried employees, like you said, will already have contributions to the Provident Fund, the Employee Provident Fund. And so the natural mathematical calculation that you will have to do is to calculate how much your contributions are, deduct that from 1.5 lakhs, and then decide where you're going to invest. But assume that we're talking about ELSS right now. Kaustubh, question to you: how are these funds managed? And we spoke about the return potential of these funds, and Prableen had a 12% number. Is that something that is consistently achievable over a long period of time?
Sure. Alex, firstly, thanks for having me on the show. And so I think Prableen really laid the context well in terms of, the options that are available to investors when it comes to tax saving, right? When you think about the ADC tax saving. Now, a couple of things that, you think about an ELSS fund. Essentially, it's run like any other diversified equity mutual fund, right? I mean, that's the one thing that just comes with an additional sweetener of tax savings when at the time of investing. When you look at the way a large part of the ELSS funds, and you rightly said, it's a pretty popular category. A lot of new first-time investors are also kind of delving into the markets through ELSS. So a lot of managers tend to focus on building, what we would call a more large cap bias portfolio. So, as data shows us that, they do have a large cap bias anywhere between 65 to 75% of the assets for most funds goes into large cap stocks and the remaining between mid and small cap. So it's a flexi cap sort of mandate, but with a clear large cap bias that comes in when you see most ELSS funds, the way they're managed, right? The other, I think, important thing that Prableen did touch upon is the return expectations. Right? And what we've seen is over long periods of time, if you have the right time horizon, typically 5 years or more. Remember, these come with a 3-year lock-in, but nothing stops you. And in fact, you should hold on to your ELS investments for longer time periods because it's like any other mutual fund. There is no need to redeem after that 3-year lock-in period is over. When you look at the rolling returns of these funds, they've been well in excess of 12, 13% over long periods of time. So I think obviously it's a function of the way the markets do. But if you're consistently investing in these funds, you can definitely enjoy the returns of what a typical diversified equity flexi cap or ELSS fund would kind of give you, and that's what we have seen with good ELSS funds that are managed. And mind you, there are a lot of marquee managers who are managing these ELSS funds within that space.
So again, interesting insights there. That 12-13% is something that you can definitely expect to achieve over a longer period of time. But Prableen, I'm coming back to you on the mode of investment, which is how do you deploy funds into the ELSS. Like I said at the start of the conversation, most people end up thinking about tax saving investments when they get that email or when they get that prod to say, okay, we need your proofs. And so then it has to be a lump sum investment. But as it is a mutual fund, the option is available to invest through the year. Should you consider SIPs? And how do you treat ELSS as part of your overall portfolio? Again, people tend to think of tax saving investments outside of their regular investments. And it should, like you said, form part of a goal that you have. So how should you treat that?
Okay, so I'll answer the second part first, Alex. Yes, tax saving and the whole planning process has to be part of your overall financial planning. And it needs decent amount of deliberation. You shouldn't just go and, park in whatever you think is right or look for the best performing fund in the month of February or March. Now, as far as the timing of investment and the mode of investment is concerned, so I did some math, and I'm just taking Franklin Tax Shield as an example. Somebody, let's say, started with their SIP in this fund in January of 2013 and invested till December of 2022. So that is 10 years. And let's consider calendar year as our financial year for now, for ease. So the person would earn about, with an investment of 15 lakhs during this time period, the returns today would be about 32 lakhs, which is quite good. And if in case a lump sum investment was done, so now we have two options. When you start, do you start in January of 2013 or are you actually doing it in December of 2013? So let's consider that because it's a last minute investment, the person invested in December. That investment today would be around 29 lakhs. So a difference of it's a very huge difference, but there is a difference of about 3 lakhs. And of course, this difference can be other way around also depending on how the markets are. But I think what is important here is the consistency that you are doing this drill year on year. You are not chasing the best performing fund. You're investing in the same fund in a planned and consistent manner. And I think if you're doing that, then over a longer period of time, Alex, I think SIP or a lump sum won't make much of a difference. I think the difference that we'll get would also depend on the market conditions. But I think the consistency is the key here. And I think the other thing, what happens is a lot of salaried people prefer the SIP mode. And when we interact with investors, a lot of entrepreneurs actually don't want to commit to a monthly sort of investment commitment. They don't want to do that. So they prefer a lump sum. So I think till the time the mode is not important, till the time you have clarity that this is what I'm going to do and this is the month when I'm going to invest, I think results should be almost similar. So the process becomes more important here.
So what I'm taking from that is it also depends on your cash flow. And for a lot of people, I think that start out, Prableen, that availability of cash flow becomes a bit of an issue towards the end of the year. You can't necessarily pull out a lakh of rupees or maybe 80,000 rupees, depending on how much you're contributing to the Provident Fund, to suddenly make your tax saving investments at the end of the year. So perhaps for those people, it's a better idea to invest through the year. In the recent past, just over the last 6 months or so, there's also this conversation about passive ELSS. And you have one fund that has come out. What is your thinking about this, Kaustubh, in terms of the opportunity that this presents? And also, I must point out that there was a recent clarification by the SEBI where they said that if you currently have an active ELSS, and from the perspective of the asset management company, they can pause or stop flows into that active fund and then simultaneously launch a passive fund, eventually merge the two. So what are the opportunities and how should a retail investor look at a passive ELSS option?
Sorry, I was, So I think, firstly, it's an interesting option. And, I think that that debate is very much in play, the active versus passive debate. We definitely think there's space for both. So it's not one versus the other. And it truly depends on, what the investor is looking for, right? I mean, the first prerogative for the investor, obviously, would be think about the fitment of that sort of asset class. I mean, it is an equity asset class, right, in his or her portfolio, right? If that's there, the next choice is, which fund do I pick? And sometimes it becomes a little challenging for an investor who's probably, kind of grappling with that. Okay, there's so many funds. How do I go about making that choice? What we call choice paralysis. And that's where a passive fund could, passive ELSS fund could work wonders. Where, instead of sitting on the sidelines and wondering that, I can't pick between these funds and making no choice, here you just come into a passive ELSS, which is mirroring, a popular index. And, you're obviously enjoying the benefits of equity investing along with the tax savings. So definitely there's space for both. That said, I think, in my earlier sort of response, I was like, there are some great run ELSS funds within that run by some superb managers. And I would definitely urge investors, even if you can do some research, kind of what Prableen alluded to, that set that plan in motion, and it shouldn't be a last minute thing necessarily. Get that discipline in. There are some great funds that you can invest, but you again need to look at that fitment of that fund within your portfolio. Because it's got to be a sort of goal-driven portfolio construction approach rather than a one-off. And I think that's the exercise every investor should do. If they can't do it, then a passive is a beautiful way of just taking exposure to equities and getting the tax benefits.
So alpha generation is something that you have to bear in mind, is what, again, I'm taking from that conversation. We'll come into the selection of funds at the end, because I've asked you for your analysis and you have a couple of options that you think people should consider. Prableen, what are your thoughts about passive? Is alpha generation going to be something that matters in the longer run? And here we're talking about 20, 25, 30 years.
So Alex, as Benjamin Franklin has said, that death and taxes are the only certainty. And if I have to put my own money, and I know that I have to put it for the next 25, 30 years, and if I have the option of just going and buying the index, I'll do that because it saves me a lot of hassle. So there is no fund selection risk. And if we look at the performance of active ELSS funds, like all other categories, there is a huge divergence between the best and the worst performers. So on a 10-year basis, that difference is about 10%, 9.87% as on date. in terms of 7 years, that difference is 12.89%. And that difference is 31% on a 3-year basis. Why do I want to take the risk of being stuck maybe with a fund which is not going to perform? Having said that, like Kaustubh has mentioned, there are some wonderfully actively managed funds, and we do recommend and we do invest in active funds as well. But I feel because ELSS and tax saving can be a core to your portfolio, because it's going to be there, you invest year on year. So if you have that option, in a simple mode, like a passive strategy, I think it's easy. So you just pick Nifty 50, like your tax saver. I think it just makes the whole investing process simple, and it's low cost and easy to understand also for a first time investor, Alex, because for a lot of people, they can't go beyond that basic 12,500 investment, at least in the initial years of their career. So I think indexing also is simpler to understand for investors. So, but of course, if they can do the research, then there is scope for alpha generation.
Yeah, and for a lot of people that have bought into the passive strategy, I think probably people who are anyway investing in the Nifty 50 index, say, and have maybe a 30-40% allocation within their overall portfolio, maybe they take a portion of that and say, okay, I'll put it in a passive ELSS. I'm anyway investing in the Nifty 50, so I can also take that tax saving advantage that I'm allowed to in the ATC. What should you bear in mind when you are choosing an ELSS? Now, obviously, you're looking at the same research and methodology that you would look at, Kaustubh, in any other equity choice or equity mutual fund choice that you do. And you've listed out a couple of options. What is your thinking? And maybe that will also help people identify what they should look at.
Sure, absolutely. So I think it's, like you rightly said, Alex, it's the uniform approach that you would take for picking any fund, be it an ELSS or a regular diversified, fund that you want to pick as a part of your portfolio. I think a few things that, are very, very important for any investor to keep in mind. I think, the first thing is, do not focus on past performance purely to make your choices, because that can really lead you down the wrong path, often getting into a fund at the wrong time, coming in mismatch expectations, right? What we need to do is try to understand the fitment of the portfolio within your overall investment portfolio, the fund, and B, evaluate how consistently has the fund been managed. Now, when we talk about consistency, returns are a result of consistent investment processes being followed, right? And returns will follow. Mind you, even the best of managers will go through patches which don't look good for them, because the markets are probably against their own style of investing. I'll give you some classic cases. When we were, in 2018, 19, growth style managers did exceedingly well, right? And value was almost written off the street at that point of time. There were several value managers who held forth to their investing process that we're value managers. We will continue to do that in the same fashion. And that paid rich dividends for them, the last couple of years, right? And growth has kind of slipped off because of that. Have growth managers changed track? Not really. They've continued to manage it the way they did, which paid benefits for them in 2018 and 19, and they'll continue to do so. And when growth turns around, they'll do well again. So these cycles continue to happen. What you need to do is, identify a manager who's been consistently following a particular style within that fund. And obviously the returns stack up, right? So I mean, when I mean the returns stack up, if a growth style manager is doing bad in a growth trending market, then that's a bad thing, because then clearly, their style's not working for them in a market that's conducive to them. The same thing would follow for a value manager. I think so. These are the analysis that you want to see. Consistency in the way the fund's been managed. Obviously, the experience of the manager, the team that's supporting him or her is also extremely important in terms of assessing that. And then, we would look to form opinions on, which are the consistently run strategies that are performing as per the expectations over market cycles.
You've identified a couple.
Right.
You want to very quickly run through why you've chosen those two?
Sure. So we've actually, so when you think about one of our popular or favorite strategies, is actually the Mirror Asset Tax Saver. Now, run by an extremely competent team, right? So Nilesh Surana, in fact, I just recently saw a tweet that he's completed 15 years at Mirror Asset. And that's a phenomenal track record that he and his team have built for them. So when you think about his style, right? I mean, he's kind of a quality growth manager, but he wants to buy them at reasonable valuations. And they've applied this trade consistently in their portfolios over long periods of time. And that really has resulted in a way, I would say, a very good performance over market cycles for the Mira Asset Tax Saver, which Nilesh manages along with a couple of other strategies. So I think it's a well-diversified strategy, given that slightly valuation conscious approach has helped him across market cycles. And he's really backed by an excellent team in terms of the primary research that's put in place. And like I said, the investment process has been consistently applied. So I think that's one great strategy. Another strategy that we like, and and the viewers would probably wonder, because it's a strategy that's probably going through some tough times right now, the Axis long-term equity. Now this, and the reason why I bring that up is because it's had a terrible last 1 year, right? But let me put some things into perspective. Now, Jinesh, who manages this strategy, has been doing this for a fairly long time with the same consistent approach, looking at quality and growth stocks. And his professed sort of style is not, minding paying some valuation premium for buying these quality growth stocks, which will pay off over the long term. If I dial back in time and I look at the period of 2016 and 17, he was running the same growth style. The fund underperformed. Come 18, 19, the fund did exceedingly well when growth came back in favor. Now it's again going through a rough patch because values come back to the fore. But the style has not changed. And that's the consistency that we're looking for, right?
Understood.
The third one, which is actually a different example, is the Franklin India Taxing, which again, a great manager in Anand Radhakrishnan. He's a more value biased manager. So I think exactly the opposite of what happened at the Axis long term is happening with this fund now. It struggled in the years of when growth was doing well, but as value has come back to the fore, this manager is doing exceedingly well, right? So it's a very different style of management in that space. And the reason why I'm kind of talking about different styles of management, all these three being run in a different style. So when you're an investor looking at your overall portfolio, if you have exposure to a certain style, if you're invested in only growth style funds, then perhaps the Franklin Taxing will be a great supplement to your portfolio in terms of a value style, which builds an all-weather portfolio, so to speak. But if you were, largely in value style managers, maybe you want to buy one of the growth style managers. So you need to complement these styles within your portfolio when you're trying to build your portfolio.
So a diversification, not just in terms of asset classes and in terms of your market capitalization, but also in terms of styles of investing.
Absolutely.
Prableen, any thoughts about these three funds that have been mentioned, and any funds that you have looked at very closely and you would like to recommend?
I'll agree with Kaustubh's choice. I think all these three funds are good, and I'll agree especially for Axis because whenever there is certain things play out in a certain market cycle, currently it's under pressure. I think, in fact, all the schemes from the fund house. So I think stay put is important. So don't keep chasing returns. I'll add, I think in the recent ones, I like Parag Parikh as well. They have very limited schemes in the fund house. So I think they do give due attention to each one. So I think along with these three, I'll add Parag Parikh to the list.
Fantastic. So I think we've had a holistic conversation, Prableen as well as Kaustubh, and we've touched on all aspects of ELSS. Thank you so much for what has been an enriching conversation, and pleasure as always speaking to you.
Thank you.
Thank you.